Good morning, everyone, and welcome. Thanks so much for joining us for our post-budget webinar. We really appreciate you making the time. Before we jump in, I would just like to get a few house rules out of the way. Please pop any questions into the Q&A button as we go. We'll come back to those at the end. Today's session is being recorded, and the recording will be shared with you afterwards. And just to keep things running smoothly, all microphones and cameras have been switched off. So what will we be covering today? We'll start with an overview. Of the market and economics, and then move on into infrastructure, and then the impact of the budget proposals on retirement funds and their members. I'm joined by my lovely panel today. Arthur Camp, Chief Economist at Sanlam Investments, Solly C, Head of Investment Strategy at Sanlam Corporate, Lisa De La Harpe, Senior Legal Advisor at Sanlam Corporate, and Donnie van Zyl, Head of Smooth Bonus at Sanlam Corporate. With that, let's kick off with Arthur.
Thank you, Melissa. Morning, everyone. So yeah, Budget 2026 has been read. It was fairly favorably received widely amongst investors, especially fixed interest investors, and what they really liked was the cut in issuance for the coming fiscal year that was announced. So we have seen bond yields coming down quite substantially over the last while, in part because of the shift towards a lower inflation target, but also this budget being very well received. Of course, of late, with the impact of the Middle East, there's been a bit of a pullback on that sentiment. But for now, we're here to discuss the budget. Right, so just to start, three charts. This is how, this is where you start off looking at the budget, the previous slide. So if we look at this, which is the most important chart here, I suppose it's the one on the right. Okay, so that's the gross loan debt ratio. And you can see there, since the global financial crisis, in fact, we've been on a very sharp upward trajectory in that debt ratio. The chart there going from 1965, so for many years we were there between 30 and 50%, and now all of a sudden, since the global financial crisis, we've spiked upwards. And a lot of this has been to do with unsound fiscal policy for many years, where we ran budgets that were focused on consumption, high wage bills, not enough capex, and along with the deterioration in the state-owned companies, that all weighed on economic growth as the government crowded out private investment. And of course, that resulted in a vicious circle, less economic growth, less revenue. And so, you get sovereign debt rating downgrades, downward pressure on the currency, upward pressure on interest rates. So it really hasn't been a nice period for a long period of time. But more recently, last couple of years, things have started to look up. Debt ratio is still very high, but now, importantly, projected to come down to 76.5% of GDP by 2028-29, from 78.9% this year. So that also has gone along with a sovereign debt rating upgrade late last year, the first one that we've seen in a very long time. And so sentiment turning more positive. But how are we going to stabilize that debt ratio? The key thing for me here, when I look at budgets, there are two things I look out for. The first thing is the intent of the government. And for intent, I can look at the primary budget balance. That's the middle chart there. And it's the green line on that middle chart. And it shows that the primary budget balance is, in fact, in surplus, projected at 0.9% for the fiscal year ending now, end of March, going up towards 2.3% of GDP by 2028 and 29. Now, that's revenue less non-interest spending, right? So if you take interest out of things, what this is saying is that we're going to literally be spending more than what we're collecting in revenue. And that is significant fiscal consolidation. It's going to take a lot of discipline from government. But essentially, that is the reason why that debt ratio stabilizes and comes down. So the intent is there. What we need, of course, is the track record. So when I say that debt is coming down in the years ahead, we had yet another year where the debt ratio was revised upwards. We've had this for many, many years in a row. We make an announcement of where the debt ratio is going to be, and then eventually the next year we just revise up again. And it was revised up by 1% of GDP for this current fiscal year. So why are we optimistic that this would start coming down? Well, now we go to the left-hand chart. So on this chart, we've got two lines, the blue one, which is revenue, and the green one, which is non-interest spending on the main budget. And so one can clearly see here that if we're going to achieve this primary budget surplus, the onus is going to rest on cutting spending relative to GDP. And that's about right. If we look at OECD countries and the history of their fiscal consolidations around the world, then it's very rare that you get a fiscal consolidation and stabilization of debt returning to a sustainable fiscal position if you're not going to cut spending to GDP. That's not an easy thing to do, because what it does, of course, is it weighs on services. And we know in South Africa, with our dire socioeconomic conditions and poor services in many areas to begin with, that doesn't augur that well. But the important thing here, though, is the intent. What we do need now is the track record. So why are businesses comfortable that this could happen, or investors comfortable that this could happen? I think there could be a few reasons. One is the fact that we've had some good fortune. We're in the middle of a very big commodity price bounce, and the Treasury has been quite conservative in pricing in those commodities, and there could be upside surprises in revenue, which stays quite stable, as you can see from that blue line, relative to GDP over the next few years. The second thing is that sovereign debt rating upgrade, lower interest rates. All of these things are conducive to higher economic growth. And that is the key thing that makes this budget hang together. Is perhaps the reason why we are more optimistic is that in recent times, especially also since the last couple of years, in fact, since we put legislation in place to allow private sector investment in infrastructure, that we've seen more belief that this economy can actually maybe gain some momentum. So when you look at medium-term growth forecasts going up towards around about 2% over the next 3 years, they're more believable. And in a sense, that is critical, because without that lift in growth, you're not going to stabilize government finances. But I think there's more belief in that reform program now. The following chart. So, obviously through all of this, we've been through a major adjustment, and we as individuals in South Africa have felt this very keenly in our pockets, right? And, so the good news in this budget was that we're not going to get the additional 20 billion rand in revenue-raising measures that had been flagged last year. And part of that reason for that was the overrun in revenue last year, 28.8 billion rand, and a lot of that had come from VAT, and to an extent company income tax and dividend payouts, which are taxed, and that's taken that off the table. But I thought that the more interesting development for the consumer here was that we're not going to have another year of bracket creep. So that left-hand chart there shows you the ratio of total tax for all categories, blue line. And obviously the first thing that you notice here is that tax has gone up from 24.5% of GDP in 2023-24 to projected or estimated 25.9% in the current fiscal year, and projected to go even higher to 26.2% 3 years out. But at least that trajectory is flat going forward. Now, what caused that jump? In large part, that jump was caused in recent years by the Treasury not adjusting the personal income tax brackets for inflation. And so you can see there the tax buoyancy. Now, the tax buoyancy, that green line, is how fast tax is growing relative to nominal GDP, so relative to income in the economy. And look at that jump there. Yes, it was depressed post the pandemic, but even so, it was a very clear jump. If there's no change to tax policy, then you would get close to one, a ratio of 1, and that's what you get the next 3 fiscal years. But that jump to 1.6 and 1.7 was the bracket creep impact. And the right-hand chart shows you how personal income tax has contributed to the total tax take in the economy. That's the blue bars right at the bottom there. So, in the early 2000s, we were contributing around 40% of total tax. Trevor Manuel, under his stewardship as Minister of Finance, brought down the debt ratio very sharply, cut taxes, including personal income taxes, and our contribution as individuals declined to 30% of the total revenue. But subsequently, it's gone back up to that 40%, and in part in recent years, it's due to that bracket creep. Companies contributing only or less than 20%, not nearly as buoyant as where it was in the early 2000s. And the reason for that is the economy is not as buoyant as back then. Profits are not as elevated. I use gross operating surplus as percentage of GDP as a proxy for that, not at that kind of level anymore. And so in that environment, companies have been contributing less. So the burden of tax has been on the individual, but good news, as I say, for the year ahead, we get that full adjustment. Following slide. Right. So from another perspective, why this is important is because consumption at the end of the day is the largest component of GDP. And at the end of a colleague of mine once said to me that the end goal of economic activity is consumption. And so, and we've all felt squeezed, and we know that real income growth has been under pressure for a number of years, and it is in fact that personal income tax that had been impacted by bracket creep. The right-hand chart there shows you household tax on income and wealth as a percentage of total gross disposable income. You can see there, Trevor Manuel era, how that had come down to 10.3% of gross disposable income by 2004. And that latest annual data we have had gone all the way back up to close to 15% by 2004. That's even higher than where we were in the early 2000s. And that's a huge drag on overall consumption spending. So this should contribute as well positively to consumption spending in the economy and overall GDP growth as well. Of course, I must make one observation. It was interesting to me that we got the increase in the limit on deductions for retirement fund contributions, effectively an additional 80,000 Rand there. And the reason I say that is interesting is look at that left-hand table. In South Africa, if you look at the total number of taxpayers who earn more than 1.5 million or 1.5 million Rand and more, they make up 3.2% of total registered taxpayers. These are the most likely to take advantage of the new this increase in the deduction, but they contribute 33.4% of total revenue. So I think this is obviously the other important development here is that for many years South Africans have not been saving enough, and this would be a positive contribution to that. Following slide. Right, now here's something that I want to focus on. So this is that debt. Now, what I found interesting about this stabilization that the government is showing in its debt ratio is that we didn't really get an improvement relative to previous projections in the primary budget surplus. In fact, the primary budget surplus is a little bit lower than previous, and yet we've got this lower debt trajectory than what was shown in the medium-term budget policy statement. Now, the black line over here shows the change each year in the level of debt, right? So in 2025-26, the current fiscal year, debt is projected to go up by 425 billion Rand. And then it comes down quite nicely next coming fiscal year to 208 billion. So the pace at which debt is accumulating is coming down quite sharply. So in absolute terms, less than half the amount of the past fiscal year in the coming fiscal year as an addition to the total. Now, why is that happening? Well, on the one hand, why are we accumulating debt? So what this chart is showing you that in large part, that sort of sea green line, that very big bar there, shows that it's mostly interest. It's mostly the fact that we're paying interest on existing level of debt, and obviously on a debt that we still acquire going forward, we also pay interest on that. That's still the main reason why this debt ratio is going up. The primary budget balance is in surplus, so that's actually detracting from the increase in debt, and that's your fiscal consolidation and your fiscal discipline. But the other things that are important here, and as I say, that primary budget balance is actually the surplus is slightly lower than what was projected previously in the MTBPS. And the part of the reason for that was the introduction of the new inflation target and lower inflation, so nominal GDP growth is slower. But nonetheless, what has really happened here? Yes, that the fact that the primary budget balance is improving is helpful and does make a difference to the sum, but it was a few other things. Most importantly, I think no more payments to Eskom, except for 10 billion Rand in 2028-29, and for no other state-owned company for that matter. Projected in the numbers. At the same time, the Jafekra balance being tapped into at the Reserve Bank. We're tapping into more of that in the coming year. And then also because interest rates have come down, we're no longer issuing bonds at a discount. And we're issuing bonds at a premium. And effectively what that means is previously you had to add that discount back to the overall level of debt. And then finally as well, inflation is lower. So when you adjust your inflation-linked bonds, there's a favorable valuation effect. You don't have to adjust by upwards by as much. And also the rand has been stronger. And we hold around 10% of our debt is foreign currency debt. So in rand terms, that debt value of that debt is lower. So these dynamics, strong rand, lower inflation, bond yields having come down, issuing debt at a premium, not at a discount, has all had favorable impacts on slowing the rate of debt accumulation. Does, in the background, tell us what we don't want is the upward trajectory again in bond yields or a weaker currency or higher than expected inflation. So we've got to bear in mind those risks, and also critically, state-owned companies. The Treasury's preferred route seems to be to issue guarantees now rather than additional payouts. Following chart. End of the day, it's going to take us a while to get there. This is about the legacy debt. Around 50 to 60% or so of our current debt is long-term fixed rate debt. That means you're going to keep on paying coupons, you're paying your coupons on that until they mature. So you only over time take advantage of issuing new debt at lower interest rates, and you can see that our interest bill is still high relative to revenue, still at above 20%, 20% seen as a benchmark. You don't want to be above there. You need to get it back down. As percentage of GDP, still quite high. And this is why, unfortunately, you have to constrain other areas of expenditure, and this is why the pressure is there on services. At the same time, just want to make one point, just from an overall perspective to demonstrate that this is not going to be an easy task, is that in the past 100 years, look at the left-hand chart there, we've only run a primary budget surplus of the magnitude required here to stabilize the debt ratio and to bring it down once. And that's when Trevor Manuel was Minister of Finance and we were growing the economy at 4 to 5%. Not growing the economy that fast now. Again, this is going to take quite a bit of doing, especially since we have potential additional health spending down the line. We wait for court cases on potential additional upward pressure on social grants. And also, we know that, there's no room here for additional bailouts to state-owned companies through the budget, perhaps potentially through guarantees with conditions. Final chart, right. So just to finish up on a positive note, so we're saying that this is going to be difficult, but at the end of the day, the task will be made significantly easier if we grow the economy faster. And we are beginning to put the building blocks in place for that. Infrastructure has been the major problem that we've had. That's been constraining growth. And so we've begun to tackle the right things, and particularly in the areas of electricity and transport, the legislation that's been put in place to enable private sector investment in those areas is making a big difference, and I think it's beginning to gain traction. Still, the state-owned companies, they're going to lead investment spending. Left-hand chart shows you the different government areas of government that will be spending cumulatively over 1 trillion rand over the next 3 years on infrastructure. At the same time, we also have public-private partnerships coming to the fore, legislation being put in place to encourage that. The budget facility for infrastructure is a conduit for investment into large projects. And the important thing that's happened here is that government has shifted to start de-risking projects in various ways. There's also the credit guarantee vehicle hopefully coming on board later this year that the minister alluded to, but generally making projects more transparent, more bankable, and reducing the risk associated with them, with investing in them, should begin to attract additional capital. And for the budget facility for infrastructure, which is our flagship here, we've had 21.9 billion rand approved last year. You can see the 5 projects for which they were approved there. And so on the right path, and I think that this reform program on the infrastructure side should get us towards 2% economic growth, I would think, if not higher, 2 to 3% over the medium to longer term. Over and above that, obviously, there are a lot of other economic interventions to top up that growth rate. Don't have time to talk about those now, but I do want to mention one thing that the minister also mentioned in the budget. Local government, 63% of them are in financial distress. There are clearly problems with maintenance. If we look at billing of water and electricity, just on the water side, there's a spread there of losses, distribution losses of between 5.9% and 53.8%. If you're that municipality, that metro with a 53.8% leakage, that means 53.8% of what's available for distribution as water you can't bill for. And so government is moving on this, particularly through conditional grants and performance-related grants, attaching performance conditions to those. A number of other interventions, don't have time to go through them here now, but they are critical, and turning around local government finances will be particularly important. And the one principle that government is going to apply quite strongly here is that if you collect revenue for something, you use it to maintain that something. So give you an example. In Joburg, 11.9 billion rand billed for water, and 1.3 billion rand of it spent on capex, leaves you with a over time accumulated backlog of 64 billion rand on maintenance there and on capex. So that principle in particular is going to be important, along with other interventions, but particularly this performance-based structure for grants. We need to keep an eye on that. That will be critical to fix that lot as well, to add impetus to our growth momentum. Yeah, that's my story. Thank you very much.
Thanks, Arthur. I think that last section was a nice segue into Solly. So over to you, Solly.
Thanks, Mel. Yeah, I agree. It's a nice segue into infrastructure. So we'll spend about the next 10 minutes looking at the developments in this area. The developments have been encouraging, but if we look at the next slide, just to look at the context. So the National Development Plan was a commission that was set up to say, how can we grow the economy at a higher rate? And the target that they set was over 5% per annum. We know that we've been growing way less than that. So one of the issues was the investment into infrastructure. So the graph that you see in there, made up of red and gray bars, just demonstrate as a percentage of GDP, how much as a country have we been investing in infrastructure? So overall, we've been below the 30% target, which was set by the National Development Planning Commission to ensure that we have higher growth. The nice thing is you can also see what that investment is made up of. So it's public investment and also private investment in this area. So the commission did recommend that the government needs to spend or facilitate 10% of GDP in the form of investment in infrastructure, and the rest will be coming from the private sector. And it's just a table on the right-hand side there to see the current percentages on what the private sector has been investing. So South African private sector has been investing around 10% compared to our peers who are investing way more. So there's a couple of issues that had made it difficult to crowd in private sector capital, including creating favorable environment for companies or private sector to invest. But also, allowing the private sector to play a meaningful role in this space. So just looking at the next slide. So the government did take a series of reforms and implement them just to facilitate investment into public infrastructure and allow the private sector to play in this area. So one of the things that were done was, how do we improve infrastructure delivery value chain? How do you identify infrastructure opportunities? How do you assess them properly to make sure that you have viable projects, and also reporting on those and including the financing of that? So I'll be touching on that. And something that Arthur touched on is, how do you crowd in private sector finance? So the assets or the money that they hold, but also technical expertise and doing this at scale. So if you look at the next slide, just to look into some of the details there on the reforms that were implemented, starting with the delivery chain. So the government realized that we need to bring efficiencies across cycles of projects. So this means efficiencies in how we identify projects, removing duplication, and having some sort of a single pipeline in terms of major infrastructure projects. And also the other thing that became clear was there was a lot of, there were efforts in a couple of places within the government and also within the departments in terms of facilitating infrastructure investments. So there is now a consolidation of those institutions. And one of the notable things was that the infrastructure fund, which I will touch on later, which has been quite key in terms of facilitating investment into public infrastructure, will be moved into the new entity that has been created, the Infrastructure Finance and Implementation Support Agency. So this has been established by National Treasury. So National Treasury has been doing a lot of excellent work in this space. So this will ultimately be housed in DBSA, which is Development Bank of Southern Africa. Arthur spoke about, it's now favorable. This space is looking better because there's transparency. So we can expect to see enhanced transparency in terms of the reporting that are done, in various parts of, government in terms of how infrastructure investments is going. And also with the Treasury just helping with technical expertise on how do we report on the progress on infrastructure investments and that have been made. And what is also encouraging is that, the public has oversight of the pipeline on major infrastructure projects. So the full budget review contain all of that. This is something it's publicly available. It is good for the public, but also for the investors as well to see, how the pipelines looking. Now, the government cannot do this alone. So there is a need for support in terms of technical expertise, but also crowding in private sector capital. So there has been some reforms in terms of bringing regulations that will look at the public-private partnerships, making it simpler for private sector to play in this space. There were some regulatory gaps that have been outsourced. So Arthur spoke about the government, undertaking guarantees, etc., which is another lever to crowding investment. So this as well, where the government is taking risk, also undertaking to guarantee some of the financing there, and also the projects is now being made available publicly. We can track this on a year-on-year basis. Another great initiative is what is called the unsolicited bid proposal. So what this does is it allows early identification of the projects. Now there is clear guidelines in terms of if like a private sector wants to propose something that is not in the pipeline, the government, something that we haven't thought of, so that can be done quicker. There's guidelines in terms of submissions and the proposal guidelines there. And then finally, on the finance leg, because the infrastructure projects require financing. So as Arthur said, our flagship financing facility, which is the budget facility for infrastructure, BFI, is going well. It's been established now. And, the pipeline, that is supported by this is being published as well. We have, I've spoken about the infrastructure fund, which also is leveraging rather on the budget facility for infrastructure. Just to augment that financing as well, the government did raise, we saw them raising a bond of around 11.8 billion, and the market liked this fund, so it was oversubscribed twice, 2 times oversubscribed. This means that around the bids that were received were around just over 20 billion. This now forms part of the budget facility for infrastructure. So this money was earmarked to finance infrastructure, which is a good development. And then just lastly, we are given updates on the key sectors. So notably energy, we need energy security. Water is now a problem, particularly in some metros. Transport and logistics, that create bottlenecks in terms of moving goods, in the economy and also in terms of export as well. Another important thing is digital infrastructure. There are some major projects there, and then other social infrastructure such as human settlement and education are receiving attention there. And then just in the next slide, just to give you a flavor of what the pipelines look like. So there is a long list, and also what's encouraging is that the list is not only long, but every project there is clarification in terms of where it is. So this is an example of what, I just took an extract from the budget review to say some of the projects, where are they, how much are they expected to cost, and all of those things, and then where are we receiving the money from these projects. So I think this will boost private sector confidence into even investing more in these. But what are the implications for the retirement funds? So our experience, we in the next slide, we have seen that retirement funds have shown interest in this area, supporting infrastructure investment, infrastructure development. So these assets are long-term, often financed over 10 to 20 years, and this is a good match for retirement fund liabilities. In simpler terms, members who join retirement funds, they typically stay there for 30, 40 years. So you need a long-term investment for that. So there has been a good regulatory support for pension fund to invest in this area, with the new limit that was introduced on infrastructure. So with the new limit as 45%. So when there are infrastructure investments, pension funds can invest in those. Another interesting thing that we've also observed as part of the Regulation 28 is that, while it's true and it's very important that the assets of the retirement funds should be invested in a prudent manner, and also in a way that protects, the long-term savings of the retirement fund member. It's also important that this capital that members accumulate or retirement funds accumulate on behalf of members is channeled in a way that achieve economic development and growth. So it wouldn't help if members have adequate savings, but they retire in a wasteland, for example. So what's nice about this regulatory, the existing regulatory support, and certainly over the foreseeable future, is that this is recognized by the government. Just further looking at the implications for retirement funds on the next slide. We have to be cognizant that these are large-scale projects. They require large amount of investment, and it's very difficult for the government or even private sector to rely on single source of investing. So the government has been innovative to bring what is called blended finance, which simply means that you're getting finance from multiple sources, from investors with various investment objectives. So for example, the government's objective will be to de-risk the projects and also take the first level of risk, but you also have development finance institutions who are taking a developmental approach, not just looking at the return objectives, but also the development of the social aspects of these things. You also have other institutional investors. Included in those is investment managers, and also banks and other major financial institutions as well. So the channel for retirement funds mostly to participate in infrastructure is through contracting with asset managers. So there are specialist asset managers that focuses on these types of investment infrastructure. So it's very common to see in one project there being participation of many asset managers, but also different major financial institutions as well. What we're also seeing is that asset managers are democratizing access to participation. Remember at the beginning I said these are large-scale projects. So democratizing access simply means that pension funds are able to allocate less assets and also play a meaningful role. So now going forward, in fact, I don't think there is a pension fund that is too small to contribute to the development of infrastructure in our country. The regulator, the FSCA, has been, trying to encourage pension funds and also now insisting that they report on the exposure on infrastructure. So this will help in terms of, tracking what has been the take-up of infrastructure by the retirement funds. And I think it will help in the overall planning as well. So if there's difficulties, those can be cleared quite timeously. It's important that retirement funds, speak to their contracted investment managers to assist with the required infrastructure reporting. And what's also nice about infrastructure investments is that there is an impact element. So these are investments that have impact in the real economy, on the participants in the economy, including the citizens. So what we've been seeing increasingly is that in addition to reporting financial successes of investments, there is now reporting on impact. And impact, traditionally, reporting was done on unlisted assets, but now it's through the spectrum. So this is something that we expect that retirement fund trustees can ask their asset managers to say, it's all good and well that I've achieved financial return. What is the return on impact there? So yeah, I think that's my story, Mel. Hopefully I did well on time.
Thanks very much, Solly. I hope that this shift to infrastructure is going to help our friends in Joburg so that they can too. Now I'm going to hand over to Dani and Lisa to take us through the impact on retirement funds. It's been a very positive budget for retirement funds, I would say. Take it away, Dani and Lisa.
Thank you, Melissa. Yes, there was a lot of positive surprises in the budget. It was quite pleasing for everybody in the retirement industry. One of the big things for me was the recognition by our Minister of Finance about how important it is for our national savings rate. And it is far below the levels that we need to really create generational wealth and also support local investment in the economy. Now, I think most people will know that we're a nation of poor savers. Our gross national savings rate is about between 12 and 14% of GDP. Now, that doesn't compare favorably with our peers internationally. Emerging market peers normally save between 25 to 35% of GDP. The OECD average is about 22 to 25%, so we're quite a bit behind where we should be. It's estimated that retirement savings on average make up about 5 to 7% of GDP. So you can think about it's about half of our gross national savings rate can be attributed to retirement fund saving. And this is quite important. It shows the importance of retirement funds in South Africa. And I know there are always certain political parties who call for a sovereign wealth fund to house the wealth of our country. But in a way, if you think about it, if you add all the retirement funds together, my colleague Solly always says, this is actually a form of, a sovereign wealth fund. It's a wealth of our people. And it's a democratized version of a sovereign wealth fund because every member can actually have a say in how their fund is managed through voting for their trustees. So I think it's quite important for me that the people realize the importance of retirement savings, not just for members, but also in the bigger picture of South Africa. Now, if we want to think about what we can do to actually increase the savings, especially from a retirement fund perspective, we can firstly try and increase contributions. But I think everybody realizes how difficult that is. The average member is struggling with the cost of living issues, and so it's very difficult for the majority of members to increase their contributions. The second thing then is to increase the contribution deducting limit. So mostly just helping those who are able to save more. And this is more those who have a higher income. And this is something we have seen in the budget coming through. We could also increase enrollment. Now, some people might wonder about this one because if you belong to an employer and an employer has a retirement fund, you're obliged to belong to the retirement fund. But it's very important to realize that not all employers are required to actually provide retirement savings or belong to a retirement fund for their members. And this is something that I think a lot of people have picked up on. whether this is not something that should be made compulsory. And then especially also for those people who are self-employed, the youngsters in the gig economy, many of them are not saving for retirement. And if you can increase the savings net as a whole, not only you're helping those members because they can now save for retirement, but you're also helping the country as a whole because there's more investment in the country. And then the last one is just increasing retirement preservation. And this is really what Two-Pot tries to achieve. A lot of focus in the media has been on the fact that people can access a savings pot. But the big news is actually that you can't access all your money anymore when you're changing jobs. That retirement pot is there preserved until you reach retirement. Now, in this part, it's not part of the budget speech necessarily, but we get a lot of questions about what our Two-Pot claims look like. So I thought I'll just give a broad highlight of what we've seen. And that's since September 2024 to December this year, we've had more than 300,000 savings pot claims. So quite a significant amount. We pay, that's about 4.6 billion rand that was paid out to members. And the average claim amount is just over 15,000. So remember, when people could see 10% of the existing savings, so a cap of 30,000, but a lot of members didn't have 30,000 rand, and had smaller amounts. So, it's interesting that we have seen actually the average claim amount come down. It started initially as around 20,000 per claim, and then gradually over time it has decreased. Once again, we see far more men than women taking their savings pot money. Perhaps it means that women are better savers than men are. And if we just look at the age bands, it does seem like it's more your members between 35 to 44 years are making use of opportunity to actually access their savings pot. Now, if we just look at the claims over time, it's also quite interesting. This is a number of claims. It started very high in September 2024 when Two-Pot came in. Lots of people claiming. It came down significantly after that. But then again, it spiked in March 2025. So remember, you can make one claim in a tax year. So as soon as March 2025 happened, a lot of people could claim again. And in fact, 75% of the people who claimed in 2025 were actually repeat claimants. So they took money in 2024, then they took money again in the 2025 tax year. And once again, after we got through that spike in March, you can see it decreasing and being fairly stable over time. Now, I did talk to our admin people yesterday. Once again, because it's now in sort of a new tax year, we did see a spike in a number of claims. It'll be interesting to see how high that spike is eventually throughout March and how it will compare to previous years. But the important thing is this is looking at it based on a number of people taking Two-Pot claims. If we just look at the numbers, it's a fairly similar graph, except you see that spike in March 2025 is a bit lower. The reason for that is a lot of the people who took money again in March 2025 didn't have enough time to build up a significant savings pot. So that's why you see the amount being withdrawn in March 2025 being quite lower. And we anticipate that there's going to be a significant portion of members who are just every year, as soon as they're able, will make their savings pot withdrawal. And that will be quite a low amount because it doesn't build up over time, but recurringly you see they're coming out. The big concern I have obviously is from a behavioral perspective. If you've now come to a situation where you've taken savings pot money for the first 2 or 3 opportunities you've had, you're creating a sort of behavior that will repeat going forward. Once you're in that habit, because it's habit forming, of taking your Two-Pot withdrawal every year, then you'll likely continue doing it every year, unfortunately, and not really using it as it's supposed to be for emergencies. So I think that's enough on Two-Pot claims for now. Let's go back to the budget proposals.
Okay, thanks, Donnie. Okay, so the first we want to highlight here is that the retirement fund contribution deduction limit has been increased. So just to kind of set the scene again, members that contribute to a retirement fund can receive, as you know, a tax deductions for contributions that they made to a fund of up to 27.5% of the greater of remuneration or their taxable income, but that's only up to a set maximum. And that previous maximum was 350,000 per annum. So this means that a member could not deduct for tax purposes contributions over that annual limit. But however, your disallowed contributions can be rolled over and then set off against tax at retirement. Now, this limit has finally been increased, and it's a quite welcome increase because it's been in place since 2016. And it's now increased to 430,000 Rand per annum. Just on that, before we move off this point, just remember that doesn't mean that this is a maximum of what you're allowed to contribute to a retirement fund. It's not. You can obviously contribute more than that. It's only the set maximum of which you will be able to deduct for tax purposes. Okay, Donnie, back to you.
Yeah, so I asked our umbrella fund team just how many people are actually already contributing more than the 350,000, and there were 1,843 members contributing more. I actually thought that's quite a low number, given that we have more than 350,000 members in our umbrella fund. But it might be that because people don't get a deduction for amounts above it, that so people are actually contributing more. The important thing, though, is even if you contribute more, you might not get a tax deduction now. You still have the benefit of getting tax-free growth within the retirement fund if you contribute more. And also, you do get the benefit on tax when you actually hit retirement and you're taking a lump sum at retirement. The other interesting thing is, after the 1,800, 827 are already contributing more than 430,000 Rand, which I think is quite positive. And if you look at the number, the ages of these people, they're mostly in their 50s. So if I have to guess, these are people whose kids are not out of the house, the kids have finished studying, and now they're actually able to prioritize saving for retirement, maximize their contributions as far as possible. And I think this increase in the limit will be quite useful for those people in that scenario to help them really save more for retirement in those crucial years before retirement. I think the other thing we've been just looking at is the contribution limit was initially set in 2016 at 350,000 Rand. Now, if you would just increase the 350,000 with inflation every year, it means that in the real terms, the new limit in 540,000 Rand, which is quite significant. So while we're very grateful for the increase to 430 and we welcome it, it would actually be an ideal world, be preferable that this limit increase every year with inflation. Now, I think I'll just jump on the tax-free savings as well. The interesting thing
sorry,
here
Donnie. It went silent for a second on my side. I apologize for that. Yeah, sorry, back to me then. Okay, so on the tax-free savings contribution limit, so the annual contribution limit was initially back in 2015 when this concept of let's say product, I probably shouldn't, but came into effect. It was 30,000 Rand per annum that you could contribute to a tax-free savings investment. If you contributed over that, you would be penalized with tax. This annual limit was increased in 2021 to 36,000, and it then remained as such up until now with the budget speech announcement. It's now been increased to 46,000 per annum. One thing that's important to note is, unfortunately, the lifetime contribution limit hasn't been increased, so it still sits at 500,000. So if you initially, back in 2015, opened up this kind of an investment and you've been contributing the maximum amount, you'll actually hit that 500,000 lifetime contribution limit in the next 3 years.
I think the important thing here is as well that there are people in the retirement industry who really question whether your retirement fund is the most efficient vehicle for emergency savings. Because, when you make a withdrawal, your marginal tax can push you to a higher bracket. And retirement savings are more long-term focused. It's not very short-term or liquid. And I think there is a case to be made that perhaps the tax-free savings account is perhaps more optimal for emergency savings. But there are obviously disagreements of that as well. And I would like to hear some of our attendees' views of that in the comment section as well, just to see what their views on this.
Okay, then with regards to the annuitization de minimis, so this has been increased from 247,500 to 360,000. But before we delve into the detail there, I just want, so we've got a little snippet there on the side that just shows you how it has been reworded as set out in the draft rates and monetary amounts bill. But if we can maybe first just take a step back and just clarify, there seems to be a little bit of confusion. Some people believe that the de minimis doesn't apply anymore since it's now post two-pot. Others believe that de minimis was actually changed back with the Two-Pot Taxation Laws Amendment Act to be 165,000, which is not correct. So just to clarify that, as you know, and maybe if we can move to the next slide, Mel, as you know that at retirement, you have to use everything that's in your retirement pot to buy an annuity. If you were an existing fund member when Two-Pot came into effect, everything that you had in the fund up until the 31st of August formed your vested pot. And as you know, all the old rules that applied continues to apply to that pot. So when you're calculating a de minimis and you have a vested pot as well, you're going to look at everything in the retirement pot and you're going to look at 2/3 of the non-vested portion of your vested pot. Now, I know that's very confusing. And I think where the confusion came in, so that clarifies that do you still have a de minimis 1/3, 2/3? Yes, you do, if there's a vested pot. So let's put that aside. The confusion with regards to no, but it wasn't 247,500, it was actually 165,000, I think came from the specific wording in the Taxation Laws Amendment Act. And if you have a look, and you can see it on the previous slide with how the referee worded it, we don't have to go back, is it actually refers to where 2/3 are less than 165,000, then you don't have to buy an annuity. Now remember, 2/3 of 247,500 is 165,000. So it's actually saying the same thing, it's just saying it differently. Now that 247,500 has now been increased to 360,000. So Mel, if you could just take us to the slide then where, and this is with effect from 1 March 2026. So when you are going to be calculating how you apply this de minimis, you are going to look at everything sitting in your retirement pot. Then you're going to look at that vested pot and you're going to look at 2/3 of the non-vested portion of that vested pot. Of the vested portion of that vested pot, and that's calculating it. And then we can move over to the next one. Right, now with regards to the living annuity commutation. So as I'm sure we all know, a living annuity can only be commuted in when I say commuted, I mean cashed out in very specific instances. And both those instances are actually set out in the definition of a living annuity in Section 1 of the Income Tax Act. Currently, there are only 2 instances, being when it falls below a prescribed minimum that's gazetted, or where the trust as the policyholder is going to be terminated. Now, up until the budget speech, this amount was 125,000, the gazetted minimum. So if it fell below that amount, then you would be allowed to cash out the living annuity for a lump sum. This limit has now been increased to 150,000. Now, the intention is definitely for this to apply from the 1st of March, but unlike some of the other that were cited in the rates bill, the draft rates bill that was published simultaneously, this new limit will actually have to be gazetted. So I do want to mention that. And then also, very importantly, is just remember this only applies to a living annuity. There's no commutation limit for a life annuity because a life annuity cannot be commuted. Okay. Then with regards to when we're talking about commutation, there's something that I think before I explain what the budget speech confirmed, let's quickly look at what was the confusion. So there was differing interpretations of the law when it comes to how do you apply that commutation limit? Do you look at per living annuity policy, or do you have to look cumulatively across one insurer or one fund in the case of where the fund took out the policy? Now, for example, the Institute of Retirement Funds of Africa strongly advocated of the application of this commutation limit per policy, because they felt that aligns with TCF and allows members with multiple smaller policies then to access their capital efficiently. Treasury does not agree with that. The budget speech now has confirmed that this commutation limit that has now been increased must be applied per insurer or per fund basis, depending on whether this living annuity is provided by the fund directly or purchased directly from the insurer. So you'll have to look at the value of all the living annuities held within that same insurer or held by the fund in aggregate. Now, it has been proposed that the legislation, which would be the definition of living annuity, that it actually is amended to make it very clear and specifically provide that this stay minimis applies cumulatively when an annuitant holds multiple living annuities within the same insurer or the same fund. And if we can go to the next slide. Okay, so I know this is quite a bulky slide. Maybe just a little bit of context, background context. So you might recall back in September 2022, the FSCA published a discussion paper on unclaimed assets in South Africa. And I'm going to refer to this as the initial discussion paper. And the whole purpose of this discussion paper was to establish what is the current status and extent of dormant and unclaimed assets. So not only in funds, in financial assets, if I can put it that way, establish current approaches, what is the criteria applied when deciding if something becomes unclaimed? How do you identify or try and trace the persons to who this money is owed? And then also to make specific recommendations to address shortcomings that has been established. So there were 13 proposed recommendations, one of which I think had everyone sit up. And one of the proposals was that financial institutions be compelled to transfer unclaimed assets to a central unclaimed assets fund, or alternatively to a national revenue fund. Now, in March 2024, the FSCA published their response to comments that they received from the industry on that initial paper. They acknowledged that, look, the transfer of these assets to a central fund or a national revenue fund presents a lot of complexities, but they stuck to their guns that they still believe that is the way to go. Now, it also stated in this response document that we can expect to see a regulatory framework being published by the FSCA. So we've been waiting as an industry for an update ever since. They previously indicated this formal regulatory framework. We should see it by 2025, 2026. And the concern is still very strong that we are going to need sufficient time in whatever this framework is to allow institutions to trace beneficiaries, as well as if there is now going to be this central unclaimed fund, that there has to be very, very rigorous regulation and oversight to ensure the proper functioning of that. So what the budget speech did announce, which is the point I'm trying to get to, is that we should see a discussion note for public consultation. Now, we've just got some stats on that slide there for you, that there is currently about estimated 88 billion rand of unclaimed assets in financial assets. That includes retirement funds and then bank accounts, investments, insurance products, etc. So, as I said, the concerns are still quite strong. It's very topical. Members have to preserve their retirement pot when they retire. So we are foreseeing that, eventually there's going to be tiny little retirement pots sitting all over the place that people might forget about. Your members, your dependents might not know about that after you've passed away. And like I said, if FSCA does push forward with this central retirement unclaimed fund kind of concept, we're going to have to see some very, very strict and rigorous regulation come out with that as well. And then I'm going to hand back over to Donnie.
Yeah, I think one of the other interesting things that came out of the budget speech, and there's a discussion paper proposing a national tax on online gambling. Now, this is something that's been very topical in the industry and wider. We have seen a lot of articles about people warning about the risk of online gambling, people using the savings pot withdrawal for online gambling, and the whole way that being indebted due to online gambling can impact on workforce morale, and it'll take a psychological strain on members, impacting their productivity. And even the National Student Financial Aid Scheme has interacted with the National Gambling Board, being concerned with the amount that students are actually using the NSFAS payments, and doing online gambling worth that amount of money. So the idea is that there might be, like you have a sin tax on alcohol and tobacco, perhaps an additional tax on your online gambling revenue, which I think will be welcomed by most people in the industry.
Thanks, Donnie and Lisa. So I've been checking the question section, and unfortunately, we have no questions. So we must have done a really good job.
Yeah.
So we've got a minute left, and I guess we can release everyone. Good luck and have a good day. And yeah, be sure to increase your retirement fund contributions. Thank you very much. Bye.
Thank you.